Okay. So, hi, we're doing a little interview with Designer Capital today. Tyler and Steve. Tyler has been helping me with my clients, and he's been growing his business over the last few years since I became a realtor, and they've been absolutely phenomenal. Also helping me buy my own house in a very, very wild market. We've got some questions we're going to go through, and because I have shifting things have shifted so much and things seem so uncertain right now for so many people. Buyers are really unclear about what's going on. So I just wanted to get some clarity from people that know best. So yeah,
That's
did you guys
awesome.
want yeah, good.
Yeah, that's
All right.
great.
I'll just dive in with my questions. So what are the current rates? We just had an increase, right?
Yes. Yeah, so current mortgage interest rates, they're the highest since 2001. So it's almost a generational thing. So yes, we've seen mortgage interest rates increase exponentially over the last 15 months. So the Bank of Canada, one of their main mandates is to keep inflation under control. Inflation, 2% is being bandied around. The reason they've had 2% as their figure, their go-to figure, is at that growth rate, it would take over 35 years for a shopping basket full of goods and services to double in price. So with the population living longer, they want to have a shopping basket full of goods and services not be too expensive in a relatively short space of time, because people are going to be living on retirement incomes for longer. So that's where that 2% comes into it. Because that's their mandate, well, they've only got realistically one tool that they can use to manage inflation, and that's interest rates. It's a big bloody hammer. And what we've seen is some real aggressive hikes by the Bank of Canada to try and get the inflation back down to its target level. 2020, 2021, people were being paid to stay at home. There was a lot of people that were unable to go places. So there was all this savings. And at the same time, interest rates were dropped through the floor. So people had this pent up demand. They also had the money to go out and spend. So in those 2 years, it went up here, people's spending habits. Typically, it just goes along here, and then it suddenly spiked all the way up. Because of that, what we had was rampant spending. And then last year, they started to increase interest rates. Now, bear in mind, the Bank of Canada had said that they weren't going to touch interest rates till 2023.
Right.
Fast forward to the end of, rewind to the end of 2021, our economy was a lot stronger than they thought it was going to be. So they started to increase the interest rates 12 months earlier than they said they would. Then Putin decided to throw his toys out the pram and invade a country. Then there were supply chain issues, and inflation suddenly was up to 8%, the highest it's been in decades. So they had to take action. There is a lag time, though. Interest rates increase. There is a lag time before people's spending habits change. So what we're seeing is the Bank of Canada took a massive action, but people's spending habits have still maintained a certain level. And that's why they're seeing inflation not come down as quickly as they thought it would. So that's why we've, sorry.
Why do you think the spending habits are staying so stable?
Cheap credit, savings. They've had the excess savings. The people were able to, they were able to save for a couple of years because they weren't able to go out, go anywhere, go abroad on holidays or whatever. Equity, it was because their home suddenly went as well. So there was a lot of free money, but cheap money available to them. And so that's where the spending habits just carried on.
Mm-hmm.
Tyler?
Yeah, very similar. The one part that we talked about interest rates, the ones that consumers pay, there's the ones connected to those Bank of Canada rate hikes and Bank Prime, and then there's fixed interest rates, and they've gone up as well because the data out there, they're trying to set bond prices, or bonds are selling, and those different people are buying those bonds as an investment vehicle, and the yield that they're seeking kind of matches with what they can get in other investment vehicles like savings accounts and things like that. And as rates go up, bond pricing tends to follow Bank of Canada, loosely Bank of Canada rates. And the one thing we've seen is an inverted bond yield. And that inverted bond yield, the term inverted means upside down, but basically a bond, if you lock up money for 1 year, you'd expect to get a lower rate of return than if you locked it up for 2 or 3 or 4. So the longer you lock your money away, you'd expect to get a higher rate of return. Inverted means the rate's actually lower for long-term money than it is for short-term. And that's a sign normally that rates are coming down. So we're seeing a growing divide in how inverted the bond market is getting. 10-year bonds now, the gap has increased quite a bit. I'm just going to pull up a slide here just to show what's happening in the market. So this little colorful graph up on the screen has 4 lines, a yellow one, a blue one, a red one, and a green one. The red one is Canadian mortgage bonds. The green one is the 10-year Canada mortgage bond. The blue one is the 5-year Government of Canada bond, and the yellow one is the 10-year Government of Canada bond. So the red and blue are associated. One's the Government of Canada and one's the 5-year and 10-year, and then the green and red are Canadian mortgage bonds. And when we look at this together, what we notice is they're fairly close together, these green and red lines, and then they start to have a little bit of a gap, meaning that the 10-year money, the green, tends to be sometimes slightly above the 5-year, which this would be normal, that the 10-year is higher or a higher rate than the 5-year. As we go along in time into 2023, we see this switch quite a bit. The red line being 5-year money and the green year being 10-year money, that's a substantial gap. So this is about 0.3%, so maybe about 0.25, that you're actually going to get 0.25% lower money per year if you invested for 10 years than if you did for 5.
Why is this?
Because they're betting that rates are going to be going down in the near future. So this is the funding sources. So if banks were passing this along, a 10-year fixed mortgage should be 0.25% cheaper than a 5-year fixed.
Right.
And normally it's the opposite. A 10-year is substantially more expensive because it's a longer period that money is locked in. So we're in quite an inverted state right now, and looking at how big this has grown, and look at the difference between the 10-year GOC and the 5-year is about 0.4% of a gap. So this large gap that we're seeing here is telling us we're probably going to see rates come down soon, or in the future rates will be lower. But there's some other things at play right now that Steve talked to, in inflation. It's a tricky game that the government has to play, or the Bank of Canada has to play, for controlling that inflation.
Do you think that they are seeing the inflation control that they want to be seeing, or not yet?
Yes, they are. So the latest figures showed that we are actually seeing inflation fall. In fact, for the first time, we actually saw inflation get down to their core inflation get down to the 2% mark. So it was 2.8 versus they were expecting to hit 3%. The latest inflation figures showed that they actually hit 2.8. That's a good thing, but they've still got a way to go, because included within that is mortgage cost. So they've actually made a bit of a rod for their own back, because within their that shopping basket full of goods and services is mortgage cost. Well, they've increased the interest rates, which means that the gap is the bit that's the bit of that 2.8 actually includes the mortgage costs, which have increased as well. If we took that out, it'd be lower.
One thing I was just going to say, Carly, is the other thing that's not so simple about dropping interest rates is dropping interest rates increases people borrowing power and may immediately run up spending.
Right.
So when they raise interest rates, there's not a perfect science to when they decide to do what's called quantitative easing. Right now, they're doing quantitative tightening, which is raising rates. Quantitative easing is when they release the pressure. Right now, the government's in consultation. I can share my screen again on changes to the mortgage rules. So right now, this actually came out in January, and not very many people are talking about this, but the Office of the Superintendent of Financial Institutions, this is their website, B20 are mortgage rules that they came in, and they're talking about mortgage lending risks, particularly related to debt serviceability of increase. So stress tests and some other things. So if we go down here, has the mortgage qualifying rate helped? Other additional things are needed. So they've talked about making a change. Instead of going from a loan to income or a debt to income restrictions. So right now, when you buy a home, it's based on monthly payment to monthly income. They take your annual income, they divide it into monthly income, and you can afford a home based on the payment. And they came out in 2016 and said, we're going to add a stress test. We're going to add an arbitrary 2% above your actual payment and say that's what we want to see fit. And it actually improved the housing market in terms of the strength and the resilience of people to continue to make their payments right now, even though rates have gone up. So I would say the stress test was a success. People had to prove they could afford more than their base mortgage rate. When they reduce interest rates, people's buying power goes up. Right now, about a year and a half ago, when rates were at their lowest, someone that qualified for $1 million mortgage has lost about 30% of their borrowing power and qualifies for a $700,000 mortgage.
Wow.
With the change in qualifying rates and mortgage payment to income. So there's a lot of people out there shopping. They've come back. We've been working with them last year. They come to us now and they go, great, there's all these homes now that are $1 million I want to buy, but they qualify for 700 because it's changed. What they're talking about is bringing in a rule. Well, instead of having it be payment to income, it be mortgage size to annual income. So a multiple, and they're proposing 4.5%. So right now, if you make $100,000 and you had a 5% down payment, you qualify for about a $400,000 mortgage without any debt, roughly. That would be a 4 times your annual income. What the government's proposing is instead of doing it based on payment, they want to uncouple the interest rate more from your qualification and go to total loan to total income. By doing that, and the number they're proposing is 4.5%, they say if you make 100 grand, you qualify for 450, 4.5 times your income, which is slightly more than they qualify for today. But if interest rates were to drop, everyone doesn't automatically go up 30% in qualifying. Because what another concern we have with inflation and quantitative easing coming in, home prices could go up another 30% if they get that buying power back that the government has restricted. So that's just something for the back of everyone's mind and just having an understanding of that.
So that's going to lessen the amount houses will increase in value. That's what you're saying.
Well, it would change the impact of interest rates to home prices going up. But we still have a supply and demand issue where maybe we're going to get multiple people coming together to buy a home.
Right.
Multi-generational living and things like that.
I wanted to touch on the how immigration is going to affect the housing here.
Yeah. So StatsCan released an incredible figure. They looked at new to Canada arrivals last year. So governments set out their targets, 430,000 people new to Canada each year for the next 3 years. Last year, they had a record 1.2 million people new to Canada. So they had a target of 430,000, I think it was, and they had 1.2 million arrive last year.
And
Now,
this immigration, like long-term living, like not.
So of that, they did have, it was 730,000 of that 1.2 were what they call non-PR arrivals. So that's your temporary workers, your foreign students wanting to come to universities and that over here to study in Canada. So 730,000 were work permits, temporary workers and students.
People needing rentals.
Exactly. Now you suddenly think 730,000 people have suddenly dropped into Canada. Where are they going to go? We're already at a shortfall with housing. CMHC released that figure that, you know, by 2030, if we carry on at the way we're going with housing starts, we're going to be a whopping 3.5 million homes short by 2030. Well, we've got people coming into Canada every single year. So big picture, property is always going to be a steady asset because the supply and demand is completely off. Immigration, is that going to be sustainable? That 1.3 million, 1.2 million? No, it's not. But it is happening and it is having an effect today.
Yeah, inflation is impacting the existing residual wood, windows, doors in your home that you own already or that you're buying goes up. Construction costs are going up dramatically because workers, they can't get enough workers to build the homes that we need. And those costs are going on. We're seeing over $300 a square foot to build right now. And in 2015, it was under $100 a square foot to build. So a 3,000 square foot home you could build for 300 grand. That same home costs $900,000.
Oh, wow.
And that's being passed along. That means the existing housing stock that might be 20 years old, as long as the wood is still dry and in good shape and structurally sound, because there's 100-year-old wood frame homes. The wood in your home is going up in value. The wood that it was $1 a 2x4 years ago, now it's $9. The wood in your home went up 9 times in value.
And are you guys seeing people moving to Victoria and South Island that are immigrating here?
Quite a bit. So right now, one, it's very expensive to live on Vancouver Island compared to other areas of Canada, but there are more expensive areas of Canada where people are moving here. So we're getting people migrating from Vancouver over to Victoria, where they're selling townhouses for $1.5 million and buying a house. So relatively speaking, there are expensive places around the world to live that make Victoria and South Vancouver Island still seem inexpensive. We're also seeing immigration and we need jobs. So we need people to come and live in these parts, but the population of Victoria is increasing for sure. Langford, for example, is one of the fastest growing cities in Canada. There's lots of work here.